Hey everybody, Joe here from Avalon. We talk a lot on this channel about running a business and using that business to generate wealth. Now, I truly believe that owning and operating a business is the best way to create wealth, and it's the primary way that I invest my time and my money. However, running a business isn't for everyone, and there are other great ways to save money, invest, and generate wealth here in Canada. In this video, I'm going to talk about two very common but also very powerful investing accounts available to Canadians. We'll look at the tax-free savings account, or TFSA, and the registered retirement savings plan, or RRSP. I'll explain how each type of account works, and the pros and cons of each account type, and when to use one account over the other. So all that and nothing else coming up. All right, so let's start with a general overview of what the heck RRSPs and TFSAs are before we get into the details. So RRSPs and TFSAs are investing accounts that are made available by the Canadian federal government. I like to think of each account as a big bucket that you can dump your cash into. The cash can then be invested in various different types of investments, and it's all done inside of that bucket. For example, let's say I took $1,000 and I dumped it into my RRSP bucket. The RSP bucket now has $1,000 of cash sitting in it. I could then use that cash to purchase investments of various types. Let's say I purchased $1,000 worth of shares in a publicly traded company like Shopify, for example. The investment is still within the RSP bucket, but the cash has been replaced by the investment in Shopify. TFSAs work the same way, where you can deposit cash in the TFSA bucket and then use it to purchase investments. So what's the point of investing inside these buckets? I'll get to that next. With an RSP, you get a tax deduction when you transfer money or investments into the registered account. In the previous example, where I moved $1,000 of cash into my RSP bucket, it was called an RSP contribution. With that $1,000 contribution, I also get a $1,000 deduction on my personal taxes in the year of the contribution. Now, this means that you'll pay less personal tax in the year that you make an RSP contribution. Then the money inside the RSP grows tax-free while it's inside the RSP bucket. Going back to our example, if I earned dividend income on my Shopify investment, that income would flow into the RSP bucket. But because it's still within the RSP, I wouldn't have to pay tax on that income. It's only taxed when you withdraw the funds from your RSP account that you have to pay personal tax on that withdrawal. The amount that you withdraw gets added to your personal income for the year in which you made the withdrawal. Then you pay the tax on the withdrawal amount at your marginal tax rate for that year. If you're not sure what your marginal tax rate is, check out the article linked in the description below. So here's a recap on how RSPs work. You contribute cash or investments into your RSP account. You get a personal tax deduction when you contribute to your RSP. Your investment grows inside the RSP bucket, tax-free, and funds are only taxed when you withdraw them from the RSP account. With a TFSA, you can transfer cash or investments into your TFSA bucket in a similar way that you do with an RSP. The cash can then be invested in various types of investments within the TFSA bucket. The big difference here is that you don't get a tax deduction when you make that contribution to your TFSA like you did with the RSP. This means you don't actually save tax in the year of the TFSA contribution. That's okay though. The investments inside of your TFSA can still grow tax-free in the same way they would with an RSP account. Then when you want to withdraw the funds from your TFSA, you don't have to pay tax on that withdrawal like you would with an RSP. So here's the TFSA recap. 1, you can contribute cash or investments into your TFSA account. 2, there is no tax deduction when you contribute to your TFSA, so you're contributing after-tax dollars. 3, your investments grow tax-free inside the TFSA. And 4, funds are not taxed when they're withdrawn from your TFSA. Both TFSAs and RSPs are great savings vehicles, but depending on your situation and investment goals, one option might be better than the other. So now the big question, which should you use? Should you take your spare cash and invest it through the TFSA account, through the RSP account, or through a combination of both? To make this decision, we'll look at a few general factors. So number 1, your investment objectives and time frame. 2, your current income level compared to your expected income level in future years. 3, what type of investment you'll be investing in. And 4, how much contribution room do you have in each account? So the first question to ask yourself is, what is my objective or goal when it comes to investing this money? Seems like a simple question, but can be a little bit complicated sometimes. So are you looking to save for retirement in 25 years? Or maybe you just want to save up for a year or two and then purchase a bright pink Tesla. Hey, this is a no judgment zone. There are really different goals, so it's important to consider your overall objective before choosing one account over the other. An RSP was designed to help Canadians save for retirement. It's right there in the name, Registered Retirement Savings Plan. So due to the nature of how RSPs work, the account is less flexible than a TFSA for short-term investing. RSP contributions create tax deductions, but RSP withdrawals create taxable income. So using an RSP for short-term investing can lead to potentially inefficient tax planning. I mean, you might end up paying tax at a higher rate than if you used a TFSA. We can summarize how your investment goals and timeframe affect your TFSA versus RSP decision. Generally speaking, if your objective is short-term investing, a few years, for example, the TFSA is likely the better choice. RSPs really start to shine when you're saving for long-term and you don't plan on withdrawing the funds until retirement. Now, the big exception here is saving for a home. You can withdraw money from your RSP and not lose contribution room when you withdraw it to purchase a home. Now, you do have to pay that money back into your RSP, so that's something to keep in mind. All right, next up, you'll want to look at your current income level compared to what you expect your income to be in the future. The reason we look at this is because contributing to an RSP is very beneficial for someone who is currently in a very high income tax bracket. The best way to explain this is for us to look at an example. So let's say that Francine, who lives in Vancouver, earns $230,000 per year. This puts her in the highest tax bracket for someone living in British Columbia. She would pay income tax at a rate of about 54%. Another way of saying this is that she will pay $54 of tax for every additional $100 of income that she earns. It also means that she saves $54 of tax for every $100 that she contributes to her RRSP. Let's compare that to Arthur, who earns $40,000 per year. He's in the lowest marginal tax rate for someone living in British Columbia and pays tax at only 20%. He'll pay $20 of tax for every additional $100 of income that he earns. On the flip side, he'll only save $20 when he contributes $100 to his RRSP. Summarizing this, we can say that if you're in a high tax bracket, you'll save more tax from an RRSP contribution than someone who is in a lower income tax bracket. This is how registered retirement savings plans were designed. It's expected that people will contribute to their RSP accounts when they are in their highest income earning years. Then when their income drops off at retirement, they can take that money out of their RSP accounts and will pay tax at a lower rate. Contribute when your income is high. That's the golden rule. Withdraw funds when your income is lower. Lower income after retirement certainly isn't the case for everyone, which is another reason why it's good to take a look at all the factors when deciding how to invest. TFSAs, on the other hand, don't have the same treatment as RRSPs. There's no deduction for TFSA contributions and no income inclusion for TFSA withdrawals. This means that your income level matters less when using a TFSA to invest. To summarize how your income level affects the investing decision, we can take a simplified view of things. If you think that you will be in a lower tax bracket when you retire than you are now, an RSP is probably the better choice. If you think you're going to be in a high tax bracket when you retire than you are now, or have higher earning years to come, a TFSA may be the better choice. And if you're not sure, I mean, who really has a crystal ball on this stuff? And you do have the cash, you can always use both. So you can use a little bit of sprinkling here to use each type of account. Next up, we'll look at what types of investments you want to hold in your RSP versus your TFSA account. The government has placed some restrictions on the types of investments that can be held within TFSAs or RSPs. But generally, the types of investments that are allowed in a TFSA or RSP are the same. And these include cash, mutual funds, securities listed on a designated exchange like the TSX or New York Stock Exchange, guaranteed investment certificates, GICs, bonds, and some shares in small business corporations. So it's a pretty large list of investments and should cover most investments who aren't looking for higher risk or alternative investment vehicles. One important area where TFSAs and RSPs do differ is how foreign dividend tax withholding is treated. If I purchase shares in a US company like AT&T, I could earn dividend income on that stock. If I held the AT&T investment in my TFSA, the foreign dividend income is subject to a 15% withholding tax. So if I earned $100 of foreign dividend income, I would only receive $85 from that dividend into my TFSA. If the investment in AT&T was held in the RSP, those dividends are not subject to a withholding tax, so I would receive the full $100 dividend into my RSP. This applies to foreign dividend income, and I'm specifically talking about US investments here. So if you purchased shares in a Canadian company, there wouldn't be the same type of withholding tax on dividend income. Quick summary on how investment types affect TFSA RSP decision. So if you want to invest in either RSPs or TFSAs, you're limited to a specific list of investment types. And it's a really large list, so not that usually that big of a deal for most people. Now, if you earn US foreign dividend income in your TFSA, you will be subject to a foreign withholding tax. If you earn US foreign dividend income within your RSP, you're no longer subject to that withholding tax. All right, so the last factor that we'll look at when choosing between a TFSA and RSP is the amount of contribution room that you have available. I'll discuss contribution limits at a very high level in this video. We've also linked in the description below some resources with the detailed information on the subject if you want to dive a little bit deeper on this. So the federal government has put limits on how much you contribute to your TFSA and RSP. There are even penalties for over contributing to each account. It can get a bit complicated, but for RSPs, you can create contribution room by earning income. The additional contribution room is equal to 18% of your earned income up to a maximum of about $30,000 per year in contribution room. If you don't earn any income, you don't generate any RSP contribution room. TFSAs, on the other hand, have a set amount of contribution room that is allocated to Canadians each year, regardless of how much income that you earn. Starting in 2009, when TFSAs were introduced, Canadians were allocated $5,000 of TFSA contribution room per year. The annual amount has increased over the years, and in 2023, Canadians will receive an additional $6,500 of TFSA contribution room. When you dump cash into a TFSA or RSP bucket, it uses up some of that contribution room that you've built up. Where the two differ is when it comes to withdrawing funds. If you contribute $5,000 to your TFSA and then withdraw it in the next year, you'll get that contribution room back. It kind of reloads itself. Now, your TFSA bucket empties out again when you withdraw the funds, and you can fill that right back up. So if you contribute $5,000 to your RSP, on the other hand, and withdraw it in the following year, you do not get that contribution room back in the bucket. It is used up, and you'll have to generate new contribution room by earning income. This is another reason why TFSAs are more flexible and often better for short-term investing than RRSPs. All right, to summarize how contribution limits affect the RSP versus TFSA decision, if you have contribution room in one account but not the other, then that really makes your decision for you. Over-contributing to one account can create penalties that you'll have to pay, and you want to definitely avoid that. If you plan on investing for the short term, then a TFSA is more flexible and allows you to regain that contribution room when you withdraw the funds. If you withdraw funds out of your RSP, you don't get that contribution room back and have to generate new room. All right, so there we have it. We looked at the general differences between RSPs and TFSAs. We also reviewed when you might want to use one account over the other. As with pretty much everything related to investing, it's important to consider your situation as a whole when making these decisions. It's also great to consult with a financial planner or investment broker to make sure you've got all the information that you need. But I've said it before, we're also here to provide general guidance on the tax side of things. So please don't hesitate to send us your questions in the comments below. We love to see them. And if you've enjoyed this video or it's been helpful for you at all, please hit the like button. That helps us. And if you like content like this or are a small business owner yourself, please consider subscribing. We really appreciate all the support we get from this community. So thanks again, and we'll see you in the next video. Cheers.